Hello everyone. I'm going to be talking to you today about book building and initial public offering and provide an economic perspective on how public offerings work. Specifically, I will compare and contrast the book building method versus the fixed price method. Ultimately, this will provide you with the key insights into how exactly an initial public offering works and how you can use it to better make your own investment decisions. My main source for this presentation will be Book Building versus the Fixed Price Revisited, the Effect of Aftermarket Trading by, I'm sure I'll mispronounce his name, Walid Y. Bousaba. This is a very excellent, very accessible paper, and I highly recommend that you read it. I'll be putting a link on YouTube to an open version of this paper, and I highly recommend you look at it. There's very little math, and it's very clear and concise. The first thing that we have to ask ourselves is, why would someone IPO? What is this initial public offering? Why is it that when Facebook IPO'd and made a very private corporate decision, all these public stakeholders such as the media, governments, financiers from all over the world were interested in this one corporate decision? What is it about a public offering that's so important? Ultimately, a public offering is about the transfer. It's a trade. It's taking something from one person and giving it to another. There are three main things that we transfer when we initial public offer our company. The first thing that we transfer is legal ownership. Ownership, written as in the books and the laws of the country where that corporation is domiciled, will transfer from the sellers, who are usually private investors, to the public, which ultimately are the shareholders in the common understanding of the term. We also want to transfer cash flows, because ultimately the buyers, the future shareholders of this company, they're not interested in holding the company just because it makes them feel good. They're interested in the future cash value that company can make from its operations. The third thing that we transfer when we initial public offer a company is the actual control, the actual day-to-day business decisions that management and employees make with regards to the future of that company. What we really want to do is we want to transfer these three things from the current private owners of this company for cash. We want to transfer these three things and take their present value as valued by the investors and trade them for current financial assets. The real question is, how do we do this? What we need to do is create these little pieces of paper called stock certificates. These days they're not paper, they're actual, usually electronic records. But at one point they were pieces of paper. And we want to take these pieces of paper and provide them to where? People who have money. An example would be this rich guy here, who is so rich he's burning his money. He's fabulously rich. A great person to sell our stock to. The answer to our problem is that we have to give our stock to those who are most willing to pay for it, such as this rich individual here. What we want to do is we want to make as many of these as possible and transfer them at the highest price to this person to give us the most cash. I'm here with the lovely Kiana, and she's going to help me go through this and explain to you how to do an IPO.
Now let me tell you how to sell our stock.
You mean my stock?
Focus, John, focus. First up, we need to determine the price.
But we cannot determine the price since we have never sold it before. This bunch of paper does not seem to have much value to me at the moment.
It has value to other people.
Well, how do we find that out?
Well, we will put the stock out to the public and gauge their response.
You mean like an auction?
Not quite. An auction is a fixed quantity exchange where the bidders have private valuation of the good in question. Your shares have an undetermined quantity, and the valuation is jointly determined by all bidders.
What does this jointly determined mean? Does it involve higher fees?
Yes. But before you get upset, it is important to realize that your shares currently have no intrinsic value. You can't use them to keep you warm at night or feed your children.
Nonsense. The money that my business makes feeds my children and their private school teachers very well, thank you.
This is true, but you have to convince other people of that fact. They need to trust that your business is not only profitable, but will remain so for the foreseeable future. Not only that, but they need to trust other people's trust in your business. That's why you've hired me, to establish that trust.
Sounds like a game of charades.
More like poker.
How should we proceed, oh trusting one?
Well, since we have a good with an undetermined quantity, we need to fix the price to provide a reference point for the bidders. This way, the bidders only need to worry about quantity demanded supplied, the number of shares that we will issue.
So all we need to do is get a bunch of investors into a room, announce our price, and sell them as many shares as we need. I should be charging you a fee.
Not quite. Our auction is not the only game in town. There is nothing that stops the investors from trading amongst themselves and ignoring us completely. This means that we have to be precise about the number of shares that we issue or proceed with a more sophisticated issuance.
What did you have in mind?
LVMH.
Counting eggs before we hatch, are we?
John, do you know what
LVMH.
sells? It's exclusivity. Why would I pay $4,000 for a handbag that will go out of style next quarter? It's because that I know 99% of other women cannot have one. What we need to do is sell exclusivity in our offering. That means that the highest price will go to the highest bidder, and he can be certain the schmuck down the street will not get in on the action.
Sounds like discrimination.
That's the point.
And it's legal?
For now it is.
So I guess we better get going before the Occupy Wall Street protesters come and hear about this.
Don't worry, they're preoccupied with the 1%, not the 0.1%.
The previous Socratic dialogue was there to provide you some inspiration for how ultimately these day-to-day decisions between the business owner and the investment banker work, and how this initial public offering happens. From more abstract or high-level analysis, there are really two methods to IPO. First one is a fixed price. When we have a fixed price IPO, we treat the stock as a commodity, something that has a consistent value across the world, across the entire sphere, and everyone faces that same price. What we're doing when we fix price is we sell to as many anonymous buyers as possible for a certain price that we give them. If you could imagine, I would literally go down the street, open up a booth, and tell any walker by, you can buy my stock for $2. And I'll just try to sell as many of those for $2 as I can. Once I'm done selling the stock, because at some point there just won't be demand for my shares that I sold at $2, because there'll be too many of them out there, and the potential investors will be aware that what I'm selling is not actually worth $2. Then the support price, my fixed price, is deemed broken, and the initial public offering is complete. Another method of replicating this, because usually it's quite stressful for investors to not, when they can't anticipate when you will stop selling, is to set a fixed window and say, everyone, I'm going to be out on the street selling my $2 stock from 9 to 10 in the morning, and any time after that you can't get access to that stock. And that way investors know exactly the window of opportunity for them to buy. The second method of analyzing stocks is book building. In book building, we really treat a stock as a ticket to an event. If you could imagine, there's those famous jokes about saying, never ask someone on a plane what they paid for the ticket price. Book building is really the same thing. In book building, what happens is that we sell to an exclusive subset of buyers at different quantities and different prices. So me, as an investment banker, I would have a book of business, a book of contacts, who I know have different prices and different values to the stock and different abilities to buy it. What I would do is I would organize the book in such a way that I think would maximize that price. Once everyone in my book of business is satisfied with their purchase, then my initial public offering would be complete. I would literally sit there in front of, if you can imagine a dealer as in a bookie, would sit there and make sure that all the bets are perfectly set before the game. And at that point, I've done my job as a bookie. Or in this case, for an IPO, it's been complete. It's really important to emphasize for book building that this isn't a corrupt process. This isn't as if I'm just dealing with my friends and excluding other people. It's important to understand that when I'm doing book building, I'm trying to entice these people who have a lot of money and are most able to buy my stock to buy it at the highest price. And by doing that, I think that I'll make a much more effective transfer of ownership from the current owners to the new owners. When we compare these two methods, book building is generally considered a much more sophisticated form of issuance. When I have to book build, I have to understand a lot about the current marketplace, the value of my stock, the situation with the investors, how do they feel about the current price. Book building is much more dominant in developed capital markets in more advanced countries, and fixed price is generally found in less advanced capital markets in the developing world. The reason is because there's all sorts of infrastructure that's required for book building. You need very sophisticated financiers, you need a stable, consistent, large user base of investors that are willing and able to allocate large amounts of capital to your firm. Fixed price offerings, on the other hand, are generally quicker and they carry considerably less risk. If you'll notice here, I am not talking anything about the cost to the issuer or to the buyer from both of these methods. It's generally accepted in the economics literature that the explicit cost, printing booklets, calling up people, even hiring investment bankers, is a very, very small portion of the overall cost of an IPO. It's typically seen that the cost for a usual IPO might run up of hundreds of thousands of dollars, which sounds like a lot of money. But in reality, it isn't, because these companies, the amount of capital that's being raised is tremendous. It's in the billions. And when you're raising $2 billion, 2 to 5 million just doesn't seem like a lot of money. I've made this diagram to help understand, compare, and contrast the differences between the fixed price method and the book building method. The black arrows here indicate a transfer of shares, and the blue dotted arrows indicate a transfer of cash flows. When we're doing a fixed price, us as an issuer, the first thing we do is we contact our investment bank and we transfer shares to our investment bank, and the investment bank in turn will transfer cash to us in accordance with those shares. This is called the share creation portion of fixed price offerings. The investment bank will in turn take the shares that I've created and trade them in what is called the aftermarket, just the general financial marketplace. If you could imagine NYSE, BATS, any number of marketplaces. For the moment, we won't get into the technicalities of listing your stock on an exchange. That's a topic for separate discussion. Me, as an investment bank, what I'm going to do is I'm going to make a fixed price offering and transfer shares to the aftermarket. The aftermarket in turn will give cash back to the investment bank, and the investment bank in turn will give cash to the issuer. The actual linkage between the issuer, the investment bank, and the aftermarket will depend on the particular arrangement that is done. Sometimes the investment bank and the issuer will only exchange cash flows before the private offering. The issuer will just say, you know what, I just want a fixed price from you. Give me as much money as you can. I don't want to deal with the risk. It's usually not the case that this happens, simply because it's very costly for the issuer to pay the investment bank to bear all that risk. What usually happens is the issuer creates shares, transfers it to the investment bank, then the investment bank transfers shares to the aftermarket, and the aftermarket pulls cash flows through. In the end, generally speaking, for a fixed price, the issuer bears all the risk of how many shares the aftermarket buys given its fixed price. In contrast to the fixed price method, we have the book building method. In this method, the issuer and the investment bank have the exact same relationship. The issuer transfers shares and receives cash. Only this time, the investment bank, instead of going to the aftermarket, it transfers shares via book building to an institutional investor. Those institutional investors in turn transfer cash flows back to the investment bank. In this case, it is almost always the case that the issuer bears the risk for this kind of arrangement, as it is more sophisticated than fixed price, and there's a lot more uncertainty as to how much money an issuer can actually raise. Given that, the investment bank is the one who controls the entire relationship with the institutional investors, it's very hard for the issuer to validate a price that any investment bank would quote it before it issues the stock. That's why it's almost always the case that the issuer bears the risk for a book building private offering. Where things get really interesting is when we show that these two initial public offerings actually have a relationship. You can see here I have the aftermarket and institutional investors. Two separate ways for me to IPO. What Walid did that was really smart is say, hey, wait a second. These two things are actually connected and they're interrelated. I, as an institutional investor, can trade in the aftermarket. I don't have to listen to these investment bankers and their book building method. I can take the stocks that I've been given and trade them in the aftermarket and make even more money than what the investment bank gave me. And I don't have to just trade money. I can also trade the stocks. I can move stocks to the aftermarket and get money from the aftermarket. And this way, it creates a big problem for the investment banker. For the investment banker, he can't use the book building method to entice institutional investors to pay him if the institutional investors can trade in the aftermarket. You might be wondering, well, why is this a concern for the investment banker? The issue is, the price of a stock is very, very uncertain. They don't know, ultimately, how much that company will make in the future. And so they have to pay the market to provide information on what it thinks the value of that stock will be. When I'm trading in the aftermarket, I can't discriminate between the different buyers. I cannot tell a buyer, hey, you know a lot about the future value of my company. I'm going to give you a lot of stock. And you, buyer, you don't seem to know much about my company. I can't give you much stock. You don't know any of those distinctions. You have to give the same price and the same expected discount. Because remember, in financial markets, if people are uncertain, it's relatively cheaper to buy that, to price in that risk, to price in that uncertainty. If you could imagine, as an investor, going and thinking, okay, I have these two options. I can go in the aftermarket, and I can buy the stock, or I can be an institutional investor and go through the book building. For me, I'm only going to agree to this book building method, and exclusively this book building method, and not trade, if the book building method gives me exactly what I want, which is provide me all the shares at a price that I think is competitive, or a price that I think is fair to me. Ultimately, for the investment bank, the reason why I would go through the book building method as opposed to the fixed price method is that in the fixed price method, I have to give a discount because of that uncertainty in the value of the company to a lot more people than I do in the book building method. In fact, I'll probably be giving discounts to people who don't know anything about the value of my company. These are short-term traders. They're just looking for liquidity to buy and to sell very quickly and not make any position as to the value of the company. For me, an investment bank, that's a bad thing because I'm giving away free money. I'm giving a discount to people who cannot help me value the company for my client. And so for me, as an investment banker, it's easier to negotiate bilaterally on a one-to-one basis with all these institutional investors, give them a relatively larger discount in aggregate per investor than they expect to receive in the aftermarket. And so ultimately, if you could imagine, what I do is I shade away the value of the aftermarket for those institutional investors. The question is, why does this work? The reason why this works is, as I was mentioning before, due to the inherent uncertainty of the future value of the assets, all IPOs have to be underpriced. This is a consistent fact that has been shown. You always have to relatively underprice ex ante an IPO to get investors to be willing to provide information as to the value of that company, because it's inherently a risky project. Underpricing causes the market to reveal information as to the stock's value, because when I see something that's underpriced, my incentive personally as an investor is to buy it, and by buying it I raise the price and provide that information as to the actual value of the company. Book building allows the issuers to bargain directly with the investors that hold the most information as to the stock's value. The problem with the fixed price IPO is that it requires investors to provide the same discount regardless of the quantity of information the buyer holds. An ultimate question from this is you're saying, Alon, alright, this is great. What should I trade? What should I do? How should I make money? This is really nice. It's very theoretical. I like the diagrams, but still, how does this help me ultimately at the end? The answer is you want to look for IPOs where there's a significant uncertainty as the underlying value of the business. Because if there's a very large uncertainty as the underlying value of the business, the investment banker, if you could remember, if we can just go back here, the investment banker here, let's say that the company's cash flows are very uncertain. It means that it's more likely that this investment banker will make a mistake as to who are the institutional investors, who knows most about the company and is most willing and most able to provide information about it. And those in turn will start trading in the aftermarket here, because they know that the value of this share that they were given is actually higher than what the investment bank quoted them at. And therefore, you as a small retail investor, you want the opportunity to make money here by trading with these institutional investors and make the difference between what the institutional investor paid and what the investment bank would have to pay in the aftermarket to all retail users. You should also focus on trading stocks with a fixed price method where there is a large syndicate of issuers. If there's a very large syndicate, if there's a lot of issuers, that indicates that there could be a lot of confusion as to the ultimate value of that company. And the company needs more syndicates, more issuers to bolster their ability to sell. In that case, chances are the value in the aftermarket will be higher. You also want to trade IPOs where you have a reason to doubt the competence of the issuer's advisors. Look for conflicts between the issuer and the investment banker. Look for investment banks with a long history of going after very difficult to value IPOs and botching them. All these things will mean that you as a short-term retail trader will be able to make a lot of money.